Thank you. I am thrilled to be here in Minneapolis, and on behalf of everyone at the Consumer Financial Protection Bureau, thank you for welcoming us to Minnesota. We are here today, as you know, to talk about student debt, a topic that is relevant to students at the University of Minnesota and to students and graduates across the country. As I'm sure you have heard, and as you've heard today, recent news reports have pointed out that student debt in this country has been climbing. Outside of mortgages, it is now the single largest form of household debt, and it's becoming a major issue, not only for recent grads, but for their families too. Now, college education is part of the American dream. It was certainly part of my American dream. As Robert Kennedy once said, education is the key to jobs, to income, to human dignity itself. When Robert Kennedy spoke those words, college was out of reach for too many Americans. Now, that has improved since then. Today, about 40% of young Americans hold college degrees. In recent generations, student loans have made the dream of going to college come true for many Americans. In some ways, the student loan market is one of the best examples of how consumer credit can open doors and create opportunities and improve lives. Today, I'd like to talk about how the Consumer Financial Protection Bureau is working to make a better student loan market. And I'd like to announce the exciting initiative with the Department of Education. But first, let me provide some context by describing some of the challenges faced by consumers in the student lending marketplace. The stakes have never been higher for students and their families to clearly understand the cost and the risk of various student loans. College is becoming more expensive. Over the past decade, tuition and fees at public universities have increased by an average of 5.6% per year on top of the rate of general inflation. As an example, the tuition and fees at the state school I went to in California are 9 times higher today than when I started college. Now, while grants and tax credits have certainly helped, college costs are a big ticket in these tough times. Many students are covering rising tuition costs by taking on more debt. According to the College Board, seniors who graduated in the last year, who had borrowed money to pay for college, ended up with about $22,000 in debt for a public college and some $28,000 in debt for a private college. More debt can mean more risk, especially in a tough economy. Our recent grads enter a job market that has been soured by the worst financial crisis since the Great Depression. Signing up for tens of thousands of dollars student loans and agreeing to pay a monthly payment that can be hundreds of dollars is a decision that needs to be made with a clear head and with clear information. Unfortunately, the combination of higher costs, more debt, greater risk has created a serious financial hardship. A hardship for millions of former students now burdened by more debt than they can afford. Since July, when we opened for business, the Bureau has been inviting consumers to tell us their stories to help us understand their experiences. One recent grad told us that 18 months after she earned her diploma, her monthly payment for a private student loan doubled from $250 a month to $500 a month. Another person told us that she didn't apply for federal loans because she was misled to believe that her parents made too much money. Now she is saddled with $160,000 of private student loans. These people, and many like them, are in trouble, partly because the complex and confusing process of taking out student loans makes it too hard to understand college costs, to evaluate loan options, and to figure out how much debt to take on. Many people just simply don't know what they're signing up for. One challenge that students face is comparing financial aid information from different schools. With more than half of enrolled freshmen saying that they applied to 4 or more colleges, it's important to be able to make side-by-side comparisons. But when prospective students find that they open their financial aid offer letters, they find different colleges often use different terms and different formats. On one school's financial aid letter, it might say that the student's financial aid would include an alternative loan, while another school calls that exact same loan an institutional loan. Or my favorite is schools sometimes use their own acronyms without ever explaining what those acronyms mean. I'm not going to single out any particular school, but I saw one award letter recently that a student's package would include $600 for a PHEAA, a P-H-E-A-A, without explaining anywhere that this is a loan, this PHEAA. Because these terms are not clear, students and families might not be able to tell which school is more expensive over the long run. So instead, too many students end up focused only on the immediate out-of-pocket costs. Another problem is that financial aid award letters don't offer information on all the different places that students can get loans. The federal government offers loans that are often cheaper than the alternatives and more flexible if a student doesn't land that perfect job right after graduation. Some states and some nonprofits also offer great loans. And then within the private student loan market, there are all kinds of loans. There are good loans, there are bad loans, there are reputable lenders, and then there are others. What's surprising is that 54% of students who take out private loans haven't exhausted their federal loan options. More than half. That means that they may be taking out more expensive, less protected, less flexible loans than necessary. Sometimes, in fact, as you've heard, the student loan market is so confusing to parents that they turn to credit cards to help pay for their children's education. For many families, that can be some of the riskiest, most expensive debt they can possibly take on. A worrisome recent trend is the increase in the number of non-traditional, high-priced private loans that are offered by or in partnership with for-profit colleges. We've heard some cases where these loans are made with little evaluation of a student's ability to repay, and without a cosigner to provide a backup source of repayment. Unlike federal loans, there's often no safety net built into the loan program, such as loan forbearance or modification rights for those who can't make payments after graduation. The schools that arrange or make these loans admit that many of the loans will quickly end up in default. A very, very bad outcome for borrowers who are just trying to do the right thing by getting a degree to improve their lives. A third problem is that students can't easily determine how much debt is too much debt. Financial aid award letters often don't even estimate what a student's total debt or total monthly payment will be, even though that information is readily available. Instead, students take a leap of faith that whatever they will owe will be affordable in 4 years, or in 10 years, or in 20 years. For students to be able to assess their ability to repay in the future, they have to consider their probability of completing their degrees and forecast their future earnings, as well as understand the terms of the loan. Now, transparency alone isn't going to fix the problem of rising college costs, but it can spur competition among schools and among lenders. And it will enhance a more fair market where people better understand the terms of what they're signing up for. Given the substantial investment that families make in higher education, clear information can help make sure that students and families take on the levels of debt that make the most sense for them. Better information, as you've heard, better information about higher education is not just a priority for the CFPB, but the Department of Education as well. In fact, the Department of Education has already made great strides by simplifying the free application for federal student aid, known as the FAFSA, so that it's no longer a form with more than 100 questions. In fact, the old version was so complicated that I once heard it described as being more complicated than the typical federal tax return. Now, given the Consumer Financial Protection Bureau's strong interest in student loans, we're pleased to be working with the Department of Education to provide better cost information to students. As has been alluded to, and as I'm excited about, one of our first initiatives is our Know Before You Owe student loan project. As part of that project, we've released a draft one-page financial aid shopping sheet, a model disclosure that colleges and universities could use to make the costs and risks of student loans clear up front before students have enrolled. With the financial aid shopping sheet, students and their families get important information that will help them make their final college selection. The prototype that we released this week makes it easier for students to compare offers side by side. Using the same format and standard terms, it clearly distinguishes between loans and scholarships and lays out options for federal aid. Finally, the draft shopping sheet outlines the full costs of attendance and estimates both the total loan debt and the monthly payments after graduation. Now, this is a prototype. It is a thought starter. It's our way of soliciting input for the Department of Education from students and their families, and from educational institutions, and from lenders. We want input as to how best to provide useful and understandable information about college costs. We're interested in your thoughts about it. You can go online at www.consumerfinance.gov to weigh in. Now, for many students today, recent graduates and others, who are already having difficulty with their student loan debt, we created an online tool that provides borrowers with information on their repayment options. We're also working to bring transparency to the private student loan market, one of the least well understood consumer credit markets, through our efforts with the Department of Education to provide a detailed report next summer to Congress. To that end, we are now asking the public for input. We're asking the public, by that I mean the higher education community, students, families, the student loan industry, both originators and servicers. We'd like to ask for information about that market voluntarily. We believe that by engaging the public early and often and promoting greater transparency, we can shed light on all types of student loans and make the market work better for students and for families. At the CFPB, we believe that a properly functioning market for consumer credit is a critical part of our economy. There's no greater example of that than in the student loan market. Student loans should make lives better. They should make the American dream possible. But to ensure that credit markets can do that, we need to make sure that they're transparent so people can avoid doing the things that make their lives worse. At its core, this is about knowing the price of a financial product before you buy it. It is that simple. And so, to all the students out there, I leave you with one request. Again, go to our website, www.consumerfinance.gov. Tell us what you think. Tell us how to make student loans work better for you, and better for the industry, and better for the market as a whole. Thank you for your time.
We have time for one or two questions from the press.
Quick question about, I'm not sure who wants to answer this, Bill Hudson from UCCO. The question we get a lot in covering these types of stories is interest rates are at an all-time low. Why aren't, when it comes to repayment, why can't students benefit from that when they consolidate their loans instead of paying 7.9 or 8.4?
Student loan interest rates in the federal programs are set by Congress, and the Congress has made decisions about how to invest resources, and in those investment decisions have decided that it's appropriate for us to have the interest rates we have. They did enact legislation a couple of years ago that called for the subsidized student loan interest rates to go down over time, and that's factored into the interest rates that are charged on the consolidation loans because it's weighted average of the underlying debt.
Alex here with Minnesota Public Radio. How does this work, if at all, with the net price calculator? It's like every college website.
So the net price calculator is a tool, as you said, institutions are supposed to have it posted to their website by October 29th. The net price calculator really is intended for students who are just at the beginning of their shopping experience, looking at colleges, and want to be able to compare them at a general way to see what their costs would be out of pocket. What this model financial aid offer form would do is provide a specific amount for a specific student for a particular program. So it's much more targeted to that individual student than the net price calculator will provide.
Is this a number they can bank on, or is this just a rough estimate?
The financial aid offer form is the number they can bank on.